So today we're going to dive into a legal case that, on the surface, looks like a drop in the bucket. We're talking $1.7 million settlement. But believe it or not, this one small number is sending massive shockwaves through the entire banking industry. And to understand why, it really all starts with that one figure. $1.7 million. That is the settlement from a class action lawsuit against Navy Federal Credit Union. Now, for an institution with over 13 million members, that's, well, it's basically a rounding error. So why are we even talking about it? To get why this is such a big deal, we got to put it in perspective. Get this. In the very same year, Navy Federal got slammed with a $95 million penalty from regulators. Why? For illegal overdraft fees. Look at that chart. The settlement we're focused on is just a tiny little sliver of that giant fine. And that brings us to the central puzzle, right? Why is everyone talking about this $1.7 million case when it's completely dwarfed by a penalty that's more than 50 times bigger? Well, the answer reveals this absolutely brilliant legal strategy that has huge consequences for you, for me, for anyone with a bank account. Okay, so to crack this puzzle, you have to understand that these were two totally different fights. One was about fees, how the bank makes its money, but the other was about something way more fundamental. The bank's basic procedures. So that huge $95 million fine? That was all about how the bank makes money. You know, hitting people with unfair overdraft fees. But our little $1.7 million case, Stevenson versus Navy Federal, had nothing to do with fees. It was about something much more subtle. How the bank follows the rules when you, the customer, report a problem. And this, right here, is the absolute key to the whole thing. The lawsuit wasn't arguing about whether customers were actually victims of fraud or not. Nope. The real fight was about whether the bank followed the correct, legally required procedure when those customers tried to report it. So this whole thing comes down to this really powerful consumer protection law called the Electronic Fund Transfer Act, or EFTA. The best way to think about it is like an official rulebook. When you see a sketchy charge on your account and you report it, EFTA lays out exactly what the bank has to do step by step. So what did the lawsuit say? Well, it claimed Navy Federal broke two very specific rules. First, when they denied a customer's fraud claim, they allegedly didn't give a good enough written explanation for why. And second, when customers asked to see the documents the bank used to investigate, they allegedly didn't hand them over. You see, we're still not talking about the fraud itself, just the process, the paperwork. And here's where this law gets really powerful. Under the EFTA, the burden of proof is on the bank. It is not your job to prove a transaction was fraud. It is the bank's job to prove that you authorized it. That is a massive shift in power, and it's totally central to the strategy here. Okay, so the bank didn't follow a couple of procedural rules. So what? Big deal, right? Well, this is where we get to the real aha moment. This is the incredibly clever legal tactic that turned a few minor slip-ups into an absolute weapon. Just imagine trying to prove that thousands of different people were all victims of fraud. It'd be an absolute nightmare. Each case would need its own unique evidence. But the lawyers here realized something brilliant. They didn't have to do that. Instead of focusing on thousands of individual fraud claims, they focused on the bank's one single process. All they had to prove was that the bank used the same faulty denial letter or had the same broken system for everybody. And that is so much easier to prove. That's the genius of it. You don't have to prove thousands of individual wrongs. You just find one systemic failure in the bank's paperwork, a crack in the foundation, and you can hold the entire system accountable for thousands of people all at once. It's an unbelievably efficient way to take on a giant institution. And this strategy allows them to sue for something called statutory damages. Now, this is important. This isn't about getting back the money a scammer stole from you. Not at all. It's a penalty, a fixed penalty that the law says the bank has to pay just for breaking the procedural rules. That's what that $1.7 million settlement is all about. So this brings us all the way back to our original question. If the money is just a penalty for bad paperwork, why is this case such a big deal? Because the real prize, the hidden giant in this whole settlement, it was never about the money to begin with. I mean, a legal analysis of the case just nails it. The settlement's true value rests in its ability to enforce compliance at an institutional level. See, the lawyers weren't just hunting for a payout. They were after a permanent fix. And they got it. It's called prospective relief, which is just a fancy legal term for saying a court ordered Navy Federal to permanently change its internal systems. They now have to revise their denial letters to be more detailed. They have to improve their process for giving people documents. They literally have to overhaul their entire fraud claim system so this can't happen again. Now, stop and think for a second what that actually costs an institution this big. You're talking about retraining thousands of employees, rebuilding entire IT systems, hiring tons of lawyers and compliance officers to watch over everything. The long-term cost of all that is going to be way, way more than $1.7 million. That is the real penalty. That's the real sting. So, we've pretty much solved the puzzle. The tiny settlement number was hiding this massive win for consumers, but the story's not over. There's one more clever little twist and some huge implications for the entire banking world. And here's that twist. It's so smart. The settlement only stops people from suing again for the procedural mistakes. It explicitly preserves their right to still sue the bank for the actual money they lost in the original fraud. So the bank paid $1.7 million to fix its process, but it could still be on the hook for all those underlying losses. And a case like this sends a massive ripple across the entire industry. It basically creates a legal playbook for suing any bank that tries to cut corners on compliance. It's a giant warning shot to every financial institution out there that failing to follow the rules, even on something that seems like simple paperwork, is a huge financial and operational risk. It effectively sets a new, much higher bar for how all banks have to treat you when you report a problem. Which leaves us with this one last big thought. This case wasn't about a bank doing something outrageously illegal. It was about them failing to properly document that they were following the rules. So it poses a huge question. Is just following the rules even enough anymore? Or do banks now have to live in a world where they have to maintain a perfect paper trail to prove they followed the rules perfectly for every single customer, every single time? Because that is a fundamentally different and much, much more expensive world for banking.